Why are 401k loans not more popular? I recently learned that there is an option to take a loan of up to $50,000 from your 401k. You pay interest on it, but the interest goes into your own account. My question is, why is this not a more commonly used loan to do things like, for example, buying a car so that any interest paid goes to you, rather than to a bank? Especially if you are allowed to continue to pay into the 401k while the loan is outstanding. When you search 401k loans, the info on Fidelity and Schwab makes these seem like a bad idea. Just wondering what I'm missing. Because it's not really a loan. It's a withdrawal of funds that you pay back over time. So you lose out on gains while the money is not paid back. Because a 401k loan is still financially detrimental in many ways, and there's a different type of risk you're assuming tying the fate of your loan to your employment status. The payments are fixed, no matter what. You can't stop, delay, or lessen payments. If you lose your job, it could all become taxable 10 penalty. Even if nothing bad happens to you, it's still an extra payment out of your paycheck, and you're losing market gains in the meantime. It's not a cheat code to contribute more. A 401k loan is a very useful tool in certain situations. It's best used for short-term purposes, as you want to avoid long-term double taxing because you're repaying with after-tax money. However, for getting money quick for very little cost, it's great. So if you have money, but have some temporary cash flow problems like a house down payment, it's a very good resource. If you don't have the money to repay it within a year, it's probably not a good idea. They make it seem like a bad idea because the interest rate you're paying back might be below what you would have made if you left that money in investments. Basically, the downside is you'd be potentially missing out on gains. If you quit, the loan is due immediately. You get double taxed on the payments. It's a retirement fund, not a car fund. Because a 401k is protected from bankruptcy if you don't take out a loan on it. I took a loan to pay back a credit card debt that was crushing me. It's working out great. I'm still contributing match and my overall debt payment is less than it was before. 7 interest to myself versus the 27 I was paying on 2 credit cards. I'm not sure why everyone is so against it. But from the calculators I saw and used from my employer plan, the loss of gains when I retire is minimal and less than the amount of total interest paying those credit cards for the next 20 years. Just did one to consolidate and get rid of debt. Couple cards, remaining student loan balance. I'm paying 8 on it back to myself. Shows the payback duration of 2 years, can do anything from 1 month to 60 months with my plan. I'm paying less on the loan in my paycheck monthly versus what I was paying on those debts per month. I found this easier than shifting amounts around to promo 0 APR cards. 401k money typically doesn't stay as cash. So when you take out a loan, you sell your shares for cash. When you pay it back, you buy the shares again. During that time, the market may go up or down. No one knows, but in general, the market is typically up. While the idea of paying interest to yourself may sound appealing, it's important to remember that the interest you earn on the loan is likely to be lower than the potential returns you could achieve by keeping your money invested in the market. You lose out on gains and pay back after tax. To address the second part, you get the money tax-free, so people need to stop using this point. As for the first part, I borrowed $30k and missed out on returns ranging from 15 to 25. Note means negative. I missed losing value on that money since it was not invested. 401k loans are the best, and if you say otherwise, you need to educate yourself and stop repeating what other experts say. I took a 401k loan out in 2008 right as the markets started to crash. The interest I paid back on the loan was more than my 401k earned over the course of the repayment. So actually I did better by taking the loan. Not the best strategy, and I didn't plan it that way at all, I just lucked into it. They are very popular. Basically, everyone has a 401k and at some point, everyone will take a loan from it. It's not a good idea if you are trying to maximize every possible penny that your life can muster through compounding, but for normal people, it's just another tool in the toolbox. Avoid it if you can, use it if it serves your goals. The purpose of the 401k is to build wealth. When you reduce your portfolio by $50,000, you are reducing your growth by that amount. Another option is to use your emergency fund and make smaller contributions to the 401k until you're whole. A big part of the reason this isn't common is because the ability to take a loan from your 401k is an option that the company has to opt into, and most company plans don't. So a lot of people don't have the option to take a loan from their 401k. Plus all the other reasons already listed by others on why this isn't the best decision to make. I have a traditional 401k as well as a Roth 401k. What's the advice on Roth 401k loans? The decision to take a loan from your 401k should be based on careful consideration of your financial goals, current situation, and other available options. It's advisable to consult with a financial professional who can provide personalized advice based on your specific circumstances. Used to work in 401k at a large bank. When you take a loan out from your 401k, you pay it back from your paycheck. The payments are taken out after taxes have been deducted from your check. So your loan payments are made with after-tax money even if it was contributed as pre-tax. Then, once the loan is paid off and you're ready to withdraw, you pay taxes on that money again. Loans from 401k essentially get double taxed. Edit to clarified, even though the loan payments are paid back after taxes, it's still considered pre-tax money. EMO, 401k loans could often be smart, but rarely wise. It sets a bad precedent. The risk of double taxation is, of course, there, too, but, in the medium term, most people could probably feel secure enough in their jobs to take the risk. I honestly think the bigger problem is that it sets you up to think of your 401k as a piggy bank when touching it should really be your last resort in any situation as a general principle. I had to take one out to pay my taxes. Positive was. No ding on my credit. No closing fees. Money came instantly. Sucks cause Terry's been a huge recovery in a lot of the tech stocks I was holding. So I pretty much sold the bottom. Also I work in tech which has been pounded with layoffs. So there is the fear that if I lose my job I'm gonna be hosed and owe it all back at once. Taking out a loan for a car is dumb. But using it as a down payment for your first home is fair. The opportunity cost of investment returns is what you're really paying. Studies have shown, though, that 401k loans are actually beneficial when taken during bear markets. Sold, then pay off as market declines. The issue here is nobody has a crystal ball. I did it to use on a down payment for a house and have no regrets. I think you just need a good purpose for the loan. FYI, my home value has appreciated far more than the money would have grown in my 401k. Especially if you are allowed to continue to pay into the 401k while the loan is outstanding. I've done that once in my career. What I found was, for me at least, that I had a difficult time paying it back while continuing to contribute at the same rate as prior to the loan. The loan was to pay off credit card debt. So I backed off on the amount I was contributing, paid off the loan in a relatively short period of time, about 18 months, and avoided doing that again. The Money Guy Show podcast actually just covered this. Check them out. I agree with what everyone says about the opportunity cost of staying in the market, but I also have a concern about payback terms. In the 401ks that I've had, the loan became due immediately if I left my employer. I believe the alternative was to pay penalties for a withdrawal. I wouldn't want to have to deal with that financial challenge if I lost my job.